Welcome everybody then. We're looking at giving advice to clients, or you're the accountant. You're giving advice to clients, or you could be an accountant in a firm as well. And we're looking at the ethical and professional issues surrounding that. And there's two really: your own competence and your own objectivity when giving advice. So what could competence mean? Obviously, keeping up to date, having the necessary skills and experience. Now, the sort of things that affect that, make you not competent, would be if you didn't have enough time to keep up to date, if you didn't have enough information available to you, you didn't have the chances to get the right experience or training, and there's just not enough resources to help you. Things that could affect your objectivity are things like self-interest. Okay, and you get self-interest from, if you know you've got a profit-related bonus coming up, then you're going to try and make profits really good, aren't you? So you're going to try and falsify a set of accounts. So you have to be aware of that. Share options, similarly, if you know you've got share options, you want the share price to go up, and you might try and make the accounts look better than they really are. Or an upcoming takeover or sale of your business. Again, you want everything to look better than it really is. So, because of that, IAS 1 comes about, presentation of financial standard statements, and that basically says, look, financial statements should be presented fairly. No failure of objectivity, no failure of competence, just present things fairly. And what it actually says is that means there must be a faithful representation. And that means a faithful representation of all the transactions. They're all being shown faithfully, all being shown truthfully, fairly. Now, to do that, basically you have to follow IFRS. But there are exceptions. In very rare cases, you don't have to follow all the standards if, in doing so, it would be misleading and not useful to the wide range of users. But that would be very rare indeed. And so, therefore, compliance with IFRS, that is disclosed in your accounts. And you have to comply with all IFRS and all the aspects of it. Can't just do some of it. And if you've done some wrong accounting, you can't put that right by simply disclosing that, okay, I've done it differently. You can go against IFRS, but when we talk about wrong accounting here, what we mean is inappropriate accounting. You've gone against IFRS, not because it's better to do so, but because you're trying to do it to your own means, and that can't be overcome by disclosure.